Most mortgage retirement mistakes happen 10 years before you actually retire. So if you're 50 plus and you have a mortgage, you better watch this video before you make a renewal mistake. See, here's the thing. Mortgage mistakes in retirement happen 10 years before you actually retire. Okay, so on the day of retirement, it's too late. And it happens 10 years before because that's when you still have healthy income and your cash flow is doing really well. Your mortgage is still active and nobody is really lining things up as far as cash flow and debt and your mortgage to work together. Right. And that's the mistake. Right. So when we talk about mortgages and your renewal coming up today, I'm going to discuss what it is that you should be focusing on. And it's not just about rate, right? Because this is really just your last big chance to reset your financial future. And this matters a lot because a lot of homeowners are earning good income today, right? You got cash flow coming in of 10, 11, $12,000 a month, and they're feeling great. But retirement income will likely be much lower. So if that looks like five or $6,000 a month for you, some people don't even realize what it is, and that's part of the reason why we have this problem, right? Because if income drops but your debt stays high, retirement's become much, much tighter than it needs to be, and you're squandering all the options and the lifestyle choices you're going to be able to have later, and that's tough to see. Right. So that's why I made this video. I'm hoping you can really zone in here and realize what's most important. Because I'll tell you, most people renew their mortgage way too casually. All right. They're focusing on things like rate, payment, fixed versus variable, what the bank's offering, the convenience of doing the renewal, but they're ignoring the most important stuff, right? Primarily their debt timeline and their future income and other monthly obligations and lining these things up so that you still have a life to live, right? We still are focusing on your lifestyle spending. And most importantly, to give you some flexibility in your retirement, right? Because that's what it's about. The lowest rate on the wrong structure is just a bad plan, right? And it's just a recipe for disaster in retirement. And we got to focus on what the real goals are, right? So the planning is all about helping transitioning people towards retirement. And we do this by looking at three distinct things. Okay. So three things that are most important, right? Primarily your debt going down is the main focus, right? Because we need to compress the mortgage and other debts. And while your income is still strong, so that allows you those options of flexibility later because those are your golden years, right? And we also want to increase your savings. So debt going down while your savings are going up. And the savings component is really important because you guys understand that you need liquidity. All right. You need to be able to be fluid when that income drops. That part's really important, right? Because racking up credit card bills to deal with emergencies or, planning vacations, even when you're retired is just an absolute disaster waiting to happen. It really does put you in a very vulnerable position. So you want to increase your savings. And listen, this is your golden year. So we want your life to be lived. Okay. So we want things like, your groceries and, entertainment, gifts, like all this stuff that happens on a weekly basis to still be intact. Okay. Right? So we want that to be quite fruitful, but also we want those short-term goals for you. We really want you to have the ability to go on vacation, help family out, do the necessary renovations as you get older. Right. So the short-term goals are just as important as the weekly spending and lifestyle habits. And at the end of the day, you know, a plan that is too focused on paying down debt is just going to make you miserable, right? And then a plan that's too focused on lifestyle and ignores the debt, well, that's not a good plan either, obviously, right? So the work here and the work we do is finding that balance, okay? So that we're doing all three of those things and you are now building more and more security, more confidence in your cash flow, in your debt, and you'll just have better outcomes in retirement. So let's just like walk through this a little more. All right. So I'll give you an example. Like household income could be really strong today, right? But you might have a mortgage and car loans, and you might be retiring in 10 years. And so when we walk through this with you, we are looking at how much we can consolidate right now. All right. And we try to shorten amortizations down, right? Save you a lot of money on interest and have more of that payment going towards the principal repayment. We're also going to find a way to commit extra monthly cash flow to go towards that principal, right? Because we're trying to knock down that balance as much as possible. And we really, really want to define what your weekly lifestyle amount is. Okay. Like, how do you pay yourself every week and build that strong habit for you? And of course, still fund the real stuff that makes life worth living, right? So, like that vacation fund, helping out others, all that stuff, all that, those buckets for the short term goals, really, really important. So, we want to anchor everything in there as well. And the project is all about making things move forward in a way so that in 10 years from now, you're in a strong position. So the power is not about like some magic product or, the interest rate. The power is directing and being intentional with your cash flow. Especially now that you're in your 50s, a lot of that extra spending on family and other people has simmered down a lot. So now you're in your peak earning years. This is your window. All right. This is your window to make things happen. And it's all about the future outcomes, right? At the end of the day, a household could have a mortgage of $400,000, $500,000. Um, and, with the right structure and just having that intention, you can drive that mortgage to either be zero or maybe $100,000 over the next 10 years. Right. And so when we get to that stage, now we then say, all right, that future goal here, how's that impact you? Well, now you can make your shelter costs a lot less. And even if you decide to sell your home, right, selling your home, that's just going to create more money in your pocket to go and travel, buy a new home and downsize. But at the end of the day, it's about imagining entering retirement with a really small mortgage, more savings, and more options, right? Because your mortgage is going to be taking away from your reduced income to the point where you're going to really feel it. So we want to create a better scenario for you. Right. It's a whole different conversation about your retirement. And at the end of the day, these conversations are about asking the right questions, right? And that's what we do. Okay. So we're interested in knowing what's your current mortgage balance, what your debts are, other things that are kind of draining your monthly cash flow. And that matters because we want to establish a starting point. We want to find out where the pressure is coming from so that we can remove it, right? Because at the end of the day, we're also interested in what your current take home income is and what your take home income is likely going to be in retirement, right? Because that's where your planning capacity comes from. And then that shows your future affordability as well, right? So when we're planning this, we're looking at what's happening now, making it better so that we optimize the situation so that in 10 years moving forward after that, you have a better scenario, right? Better outcomes. And we really focus on how much debt we can compress over the 10 years. That's what it's all about, right? We create this pathway over the next 10 years. And we also want to know and figure out how much liquidity can you have, all right? Like we want you to stay liquid and fluid because that's what's going to protect your lifestyle. That's what's going to help you deal with emergencies when they come up. And the payment at the end of the day at retirement defines the target. Okay. So if you get your mortgage down to like $100,000 from that four or $500,000 a month amount that it's at now, at that time, even if your income's dropping by half, your mortgage payment's going to drop by like two-thirds, if not more, right? It could be as literally as little as, you know, four or $500 a month, right? Coming down from like $3,000 a month. So you can imagine like that's immense amount of savings for you. And that's going to define how well you live in what is supposed to be your golden years, right? So super, super important. So before you renew, especially if you're within this 10-year retirement span here, you got to really understand You got to take a pause and make a decision that's not about rate. All right. This is all about looking at your current income, being intentional about it, and realizing your future income is going to rely on the decision you make today. Okay. So this is about making your cash flow, your debt, and your mortgage work together for you, because the decisions you make now will decide the freedom you have later. So if you want to look at, excuse me, if you want us to look at your mortgage through a cash flow lens, reach out, reach out to us because we can review the numbers with you and we can figure out your pathway over the next 10 years. Thanks so much for listening.